Hello. Hello. Okay. Uses of liquidity ratios. Evaluating short-term solvency. Liquidity ratios help stakeholders assess a company's ability to meet its short-term obligations. Assessing cash management. Liquidity ratios provide insights into a company's cash management practices and its ability to generate cash from its operation. Do we can you hear now? Sorry, I don't know when the sound stopped. Okay. Okay. I'm trying to turn the mic was off, so I don't know whether it's on now. I didn't know that the mic was off for a long time. I don't know how long it was off. But now I want to know if it is on now. I think it's on now. Check. Check. The mic should be on now. Uh, let me check. It's on now. Hello. If there is no hold back. Hello. I think is the mic on now? Check. I think it's on now. The mic should be on now. Okay. The mic is on now. Sorry. For how long has it been off? Hope it has not been off for a long time. Okay. So I will watch out now so that I will ensure that the mic is always on. Why didn't somebody call me when you know that it's like this? People just kept quiet. That one. Okay. So the whole lectures now. Anyway, you can read it up if you did not hear. I didn't know. Okay, so we are looking at use of liquidity ratios, evaluating short-term solvency. We'll talk about that. Assessing cash management. Liquidity ratios provide insights into a company's cash management practices and its ability to generate cash from its operations. Identifying potential liquidity issues. Liquidity ratios help identify potential liquidity problems, allowing stakeholders to take corrective action. So if the company is not liquid, of course, it will not be able to pay its suppliers. Even salary will be difficult to pay. So if they see that they compute liquidity and they see that liquidity ratio is not doing well, they will take action in order to solve this problem. They will take corrective action. Comparing with industry averages. So the company uses the liquidity ratio as a comparison with what the industry average is, so that they will be able to determine if they are making, if they have, if the company is liquid or not. Making credit decisions. Liquidity ratios are used by creditors to evaluate a company's credit worthiness and ability to repay its debts. While the outsiders or suppliers will evaluate the liquidity ratio of a company to know whether they should give them credit or not. The company itself also will look at their liquidity ratio to know whether they should give credit or not. So they might say, no, because of our liquidity issue, we will not sell on credit. It's either we don't sell than sell, and we're having this liquidity problem. So that's it. It will help the company to make credit decisions. It will also help uh, the customers to also make credit decisions. That's what liquidity ratio does. Now I am going to look for a question, and then we will solve for all the ratios. If I didn't see that question, then I will refer you to the videos on profitability ratio and liquidity ratio. But I think I will find the question now. Let me look at my computer, and I should be able to find the question on liquidity, on profitability and liquidity ratio. So I will display that question to enable you look at it before we solve. Uh, Profitability ratio. Okay, let me check. I've seen the question, but it's not in PowerPoint. Let me see whether I can display the words in this place, if I can display it better for us, so that I display the liquidity ratio question before the solution. Okay. Uh, is there? Is there? Okay. Okay. Let me see if you can see it. See. Okay. Okay. Can you see the question? Okay, that's the question on liquidity. Sorry, on profitability and liquidity. On profitability ratio and liquidity ratio. You can copy it because we are going to solve them now. So, are you guys seeing it? Now, it's a ABC Corporation Consolidated Statement of Comprehensive Income for the year ended 31st December 2022. Revenue 1 million. Cost of sales 600,000. Gross profit 400,000. Other income 50,000. Operating expenses, we have salaries and wages 100,000. Depreciation and amortization 50,000. Other operating expenses 20,000. Total operating expenses 170,000. Operating profits 280,000. Then finance income 10,000. Finance costs 60,000. Then we have profit before tax 230,000. The finance cost is in negative, so the bracket is both sides. It's only one side here, but the bracket should be both sides. Then we have income tax expense 75,000 negative. The profit before for the year 155,000. So we have the statement of financial position too. Current assets, cash and cash equivalent 100,000. Trade and other receivables 120,000. Inventories 80,000. Total current assets 300,000. Okay, so let's move ahead. Okay, so here you can see we have non-current assets, property, plant and equipment 400,000. Intangible assets 100,000. Total non-current assets 500,000. Total assets 800,000. Then we have current liabilities is 100,000. Current current liabilities, trade and other payable 100,000. Current tax liabilities 20,000. Short-term borrowings 30,000. Total liabilities 150,000. Then non-current liabilities, we have long-term borrowings 100,000. Deferred tax liabilities 50,000. Total current liabilities we have 150,000. Total liabilities 300,000. Okay, so we go to equity. Equity, share capital 200,000. Retained earnings 300,000. Total equity 500,000. Total liabilities and equity 800,000. Additional information. Outstanding shares 50,000. Market price per share 20 naira. Dividend per share 1 naira. Dividend declared 50,000. Calculate the following ratios. Profitability ratio, gross margin ratio. Now, in the profitability ratio, we are going to calculate gross margin ratio, operating margin ratio, net profit margin ratio, return on asset ratio, return on equity ratio, return on sales ratio, earnings per share, price earnings ratio, dividend per share, dividend yield, earnings yield, return on capital employed. So these are the ratios we are going to calculate for profitability. These are the profitability ratios we are going to calculate. I hope we're there. Okay. Okay. Then we look at the other ratio, the liquidity ratio. We calculate current ratio, quick ratio, and cash ratio. So these are the ratios we are going to calculate on liquidities. Okay, so let me look for the ratio computation sheets so I can bring it for us to look at. Okay, we've seen this now. You know, so this is what I want. Let me get the ratio. Okay. Solution to profitability and liquidity ratios. Okay, so I'm looking for the file. Okay, so let's go. If we can back on there. That's not. So good. This is what I want now. Yeah. Okay. Solution to profitability and liquidity ratios. Profitability ratios. We have gross margin ratio. Gross margin ratio is equal to gross profit over revenue multiplied by 100 over 1. So we have 400,000, which is the gross margin from the question, and then divided by 1 million, which is the revenue, times 100 over 1. That will give us 40%. This ratio indicates that for every naira of revenue, ABC Corporation has a gross profit of 40 kobo. So that's the indication of the ratio. Now, one thing I need to point out to you is that It's not just computing the figures that is important in ratio computation, but to be able to interpret what the figure means is very, very important. That's what we should look at, interpreting what these figures mean. So this ratio indicates that for every naira of revenue, ABC Corporation has a gross profit of 40 kobo. Then two, operating margin ratio. Operating margin ratio is equal to operating profit over revenue times 100 over 1. The operating margin ratio, operating profit is 280,000 divided by sales of 1 million times 100 over 1. That will give us 28%. This ratio indicates that for every naira of revenue, ABC Corporation has an operating profit of 28 kobo. So for every revenue they sell, they make 28 kobo operating profit. We have a net profit margin. Net profit margin ratio is equal to net profit over revenue times 100 over 1. The net profit here is 155,000 in the question over 1 million times 100 over 1. That will give you 15.5%. This ratio indicates that for every naira of revenue, ABC Corporation has a net profit of 15.5 kobo. Hello, I hope we are there. Okay, 15.5 kobo. Hello, can you guys hear me? Can you hear me? Let me know. Okay, so it's fine. Okay, that's we've done net profit margin ratio. Let's look at return on assets. Return on assets equal to net profits over total assets. Now, when we talk about total assets, if you look at a statement of financial position that has a T format, the total assets is the uh, total at the bottom of the T formatted account at the left hand side or the right hand side. So you can see that total assets is equal to non-current asset plus current asset equal to total asset. You can get it from that side of the statement of financial position or the other side. So it will be equity plus liabilities. You remember the accounting equation. Asset is equal to equity plus liability. So it's either you add equity plus liability to get a total asset, or you add current asset plus non-current assets. So we're having 155 over 800 times 100 over 1 equal to 19.38%. This ratio indicates that ABC Corporation generates a return of 19.38% on its total assets. So for the total asset is making, they are making a return of 19.38% on the total assets of the organization. Return on equity. Return on equity. So return on equity is equal to net profits over total equity times 100 over 1. Now, the net profit we are talking about, you know that it's profit after tax. So it will be 155,000 over 500,000 times 100 over 1, which will give you 31%. This ratio indicates that ABC Corporation generates a return of 31% on its total equity. Return on sales, ROS, is equal to operating profit over revenue times 100. Operating profit is 280 and sales is 1 million. So that would be 100 over times 100 over 1. Now we calculated this ratio before when we are calculating operating margin ratio. So it's still the same that we calculated. Look at the operating margin ratio, you see operating profit over revenue. So here we talk about return on sales. This ratio is the same as the operating margin ratio. Earnings per share. Earnings per share is equal to net profit of outstanding shares, equal to 155,000 over 50K. The outstanding share was given there. So it gives you 3 naira 10 kobo. This ratio indicates that ABC Corporation has an earnings per share of 3 naira 10 kobo. So it means that for every share, they earn 3 naira 10 kobo on top of every share. Price earning ratios. Price earning ratio is equal to market price per share over earnings per share. So in this, you see that the market price per share is into another ratio, earning per share. So in order to get your uh, price earning ratio, you must calculate your earnings per share. So it is when you have finished calculating the earnings per share before you can calculate your price earning ratio, which is equal to market price per share over earnings per share. So that would be 20 naira, which is the market price per share in the question, over okay, sorry, I think I lost the mic. Don't know how long that has taken. Okay, I think I've corrected it now. I have corrected it. When did you stop hearing? Now you can hear me. I think I had my mic had battery problem and I didn't notice. Maybe I should put the mic here so that I will always know when the when there is battery problem. Oyinbra, but you can hear now. Which of the concepts, which of the uh, ratios should I go back to explain? Okay. You are not answering my question. Okay. So can you hear me now? I want to know if you can hear me so I can go ahead. The seventh ratio. Okay. I'll go back to it again. Okay, earnings per share. So I was saying that earnings per share is equal to net profit over outstanding shares equal to 155 over 50,000 naira. I told you that the over outstanding shares, that's the number of shares, not the value of shares. I'm going to demonstrate the difference between this in class when I come. I will try and explain that. Now, the number of shares was given in the question. So we have 3 naira 10 kobo. This ratio indicates that ABC Corporation has an earnings per share of 3 naira 10 kobo. Price earning ratio, PE ratio. PE ratio is equal to market price per share over earnings per share. So you can see that in this, we are calculating this ratio using another ratio, earning per share. We are calculating PE ratio using earning per share ratio. So we have computed earning per share previously to be 3 naira 10 kobo. So that's what we're going to use. And the question gives us market value per share of 20 naira. So we have 6 naira 45 kobo. This ratio indicates that investors are willing to pay 6 naira 45 kobo for every naira of share of earnings. So for every earnings they make, they are willing to pay 6 naira 45 kobo. So when a share is earning 1 naira, the investors can pay 6 naira 45 kobo for that 1 naira. So they are satisfied with making 1 naira out of their 6 naira 45 kobo. Dividend per share. So I said that dividend per share is given in the question as 1 naira per share. So this ratio indicates that shareholders receive 1 naira dividend for every 1 naira share held in the company. Now, like I was saying, that the earnings of the company is not always equal to the dividend that is paid out, because the company might earn a particular amount of money and decide to keep some in running the business and then pay some out as dividend. So in such a situation, the dividend paid will not be equal to the amount earned. So there is something they call dividend payout ratio or earning retention ratio. So this shows the percentage of earnings that is paid out as dividend and the one that is retained as this thing, the one that is retained by the company. Excuse me. Okay, are we there? Sorry, I left my car open and they just came to tell me. So I was trying to say that the dividend that is paid out is determined by the retention ratio the company has or the dividend payout policy they have. So if they made 50,000, does not mean that they will pay all the 50,000 out as dividend. They can decide if they have a retention ratio of 50%, which means what it means is that they're going to pay 50% of their earnings as dividend and then retain 50%. So in this case, they will pay out 25%, 25,000 and retain 25,000 to run the business. Dividend yield. Dividend yield is equal to dividend per share over market price per share equal times 100. So we have 1 naira, which is the dividend per share that we calculated here. You know that dividend per share is equal to the profit over the number of shares that the company has. That is the formula for dividend per share. So dividend per share over market price gives you the dividend yield, and this is computed to be 5%. This ratio indicates that investors can expect a dividend yield of 5%. Oh, okay. Then we have earnings yield. Earnings yield is equal to earnings per share over market price per share. So we have also calculated the earnings per share and then the dividend per share. So earnings per share now over market price. Market price is given, earnings per share was calculated to have 15.5%. This ratio indicates that investors can expect an earnings yield of 15.5%. Okay. I hope you guys are hearing me. Please indicate if you are not. Return on capital employed. Return on capital employed is equal to operating profits over capital employed times 100. First, we need to calculate the capital employed. Capital employed is equal to total equity plus non-current liabilities. That is 500,000 plus 150,000 equal to 650,000. Next, you can calculate the return on capital employed. So it will be 280. Please don't mind the dollar sign. It's supposed to be a naira sign over 650 times 100, which is 43.08%. Yes. Okay. So therefore, the return on capital for ABC Corporation is 43.08%. This indicates that for every naira of capital employed, the company generates a return of 43 naira, 43.08 kobo. So look at the capital employed. Capital employed is equal to total equity plus non-current liabilities. It can also be equal to total assets minus current liabilities. That's another way. Total equity plus non-current uh, liabilities is capital employed, or total asset minus current liabilities. So that will give you capital employed. So we have seen how we calculated the rows. So we go to liquidity ratios. Current ratio. Current ratio is equal to current asset divided by current liabilities. That will be 300,000 minus 150,000. That will give you 2. This ratio indicates that ABC Corporation has twice as many current assets as current liabilities. ABC Corporation has twice as many current assets as current liabilities. Quick ratio. Quick ratio is equal to current asset minus inventory over current liabilities. So the current asset there is 300,000 and the inventory is 80,000 and current liability is 150,000. So we have 1.7, 1.47. This ratio indicates that ABC Corporation has 1.47 times as many liquid assets, excluding inventory, as current liabilities. So this ratio can be stated as 1.47 is to uh, 1. Cash ratio. Cash ratio is equal to cash and cash equivalents over current liabilities, equal to 100,000 over 150,000, equal to 0.67. This ratio indicates that ABC Corporation has 67% of its current liabilities covered by cash and cash equivalents. This is a very good ratio because it means that they can pay their current liabilities anytime. Okay, so this is illustration of the ratios, profitability and liquidity ratio. Uh, we have spent some time on this. If there is any question, you type it on the chat box. Let me hear. Let me see. You are laughing. Look at you, Juliet. If there is no question, let me know if I should continue to, if I should move to activity ratios. Go ahead. Oyinbo, go ahead. Type the question. I will see it and respond. What's the question? Let me know what the question is, and I'll try to respond to the question. Yes. Brakemi, what's the question? Is your network bad? I know it's a network problem. That's why I'm not go ahead and ask the question. For it's a question. If you don't have the question, I will move ahead. The next one is efficiency ratio. Should I continue? Should I continue? Let me check. Okay. Okay, so what's your question on dividend per share? Yes, let's know what your question is. I said dividend per share. Let's see. Okay, I said that the dividend per share is given in the question as 1 naira. But however, to compute dividend per share, it will be dividend paid over number of shares. Over number of shares. So now that the the question already gave us dividend per share as 1 naira, what it means is that for every 1 naira share held in ABC, you will receive a dividend of 1 naira. ABC Incorporation will pay out each shareholder 1 naira per each 1 naira different dividend that they are holding. So let's assume that somebody is holding 50,000 shares in ABC, and ABC declared 1 naira dividend per share. That person is going to receive 50,000 shares times 1 naira, which is going to be 50,000 naira. And I also said that it is not all the time that the company pays uh, dividend, or that it is not all the amount of money the company makes as profit that they pay as dividend. They might make profit and pay part of the profit as dividend and retain part of the profit as retained earnings in the company. This is because it will serve as part of the working capital. They will re-inject that money into the business to assist the business. I said that the payout of dividend might depend on the company's dividend payout policy, or what is called retention policy. Retention policy is just the other side of dividend payout policy. Retention policy is the percentage of earnings that is retained in the business and not paid out. While dividend payout policy is talking about the amount, the percentage of earnings that is paid out as dividend. So the earnings of the company is divided into retained earnings and dividend. They either retain all the money that they earned in that year or pay out some as dividend. They can also pay out all the money that they earn as dividend. So in such a situation, we say that the dividend payout policy is 100% earnings, or the retention earning is zero. Sorry, the retention policy is 0%, which means everything they make, they pay. Everything they make, they pay. They don't keep any money in the company. They don't keep any earnings in the company as part of running the business. So that's what I explained in dividend per share. So I don't know. Let me check if it's still okay. Maybe do you want me to go back to the question? Okay. Any other question? Okay, let me. So, ladies and gentlemen, we have looked at uh, profitability ratio and liquidity ratio. If you want a wider and detailed explanation, you still go to my video on profitability and liquidity. If you go to the video, it's better explained because I took my time to go through it and explain. So combine this video with that video, it will help you to understand profitability and liquidity ratio. Now, I want to tell you that questions on ratios are not just about computing ratios. Because to compute ratio is very, very easy. That's why the topic is interpretation of financial statements. Interpretation of financial statements. When you have calculated the ratio, how do you interpret the result of the ratio that you calculated. How do you use the ratio in the ways that we itemize when we are learning the beginning part of ratio? We told you what we use ratio to do. How do you use it to evaluate a company liquidity, to evaluate a company profitability, solvency, activities, and all the rest, efficiency also. So you might be given a company's position and asked to evaluate that company, whether the company is profitable or not, whether the company is going to become insolvent. So it is ratio that you use to calculate in order to make this advice. Even when you are to value a business at all, ratio is very, very important. So it is what you make out of the ratio that you calculated that is more important than the mathematics of or arithmetic of calculating ratio. So you must read in depth in order to know what to do with the figures that you have calculated. For those of you doing ICANN, you believe you agree that if your case study is hinged on ratio, if you know ratio very well, case study will not be that difficult for you to handle. So while we look at all this, we are going to conclude the profitability and liquidity ratio today, and then we move on to activity or efficiency ratio and long-term solvency to stability ratio. So when we have treated this might be the end of ratio class. So I had intended to come to class today to treat this, but unfortunately I couldn't make it because of the things that stood on the way. And now we have studied this profitability, and I had thought I was going to conclude the profitability, the liquidity, efficiency, and the other one, but I tell you, I am tired, and I have to end the lectures from here. So, ladies and gentlemen, I want to tell you that I appreciate your logging in spite of the time. We are going to continue to work together. Now that we have looked at ratio analysis, this part of ratio, I'm going to give you, very soon I'm going to give you the, the assignment that I said is going to be a group assignment that will warrant you to go out or to use the sources I told you before, and then solve the ratio problems I'm going to pose. So while that is still on the way coming, I want to say thank you for joining. We'll continue next week with physical learning. And then after that, we are going to solve a class question, an assignment discussion, an assignment online, like we did before. But for now, it is fine. Thank you.